Welcome back. Well, the market's a little bit lower. A couple of stocks are moving violently. One is PVR because the occupancies are still lower than what we saw pre-COVID, so that's lower. While Coforge is flying away, we'll get to the management in just a bit. But let's get chatting with the management of India Mart. Well, that's the next corporate on our radar. Well, the numbers are more or less mixed, but let's understand more about the outlook from here on. We're joined by Mr. Dinesh Agarwal, the founder and CEO of India Mart. Good morning, Mr. Agarwal, and thanks so much for joining in. Well, I have a two-part question. One is the number of subscribers, that's the subscriber addition, was around 6,300 approximately. Earlier you were telling us that it could be around 8 to around 9,000 odd. So if you could tell us, do you maintain that sort of a guidance on a quarterly basis? Do we get back to that? And also margins, have they bottomed out? Yes, we get that point that, in the interim, it was unreasonable to see it at 35 to 40%. But what is the margin band we should work with? Because most brokerages are working with margin uptake. Go ahead, sir.
Yeah, so I think on the number of customers quarterly addition, we continue to maintain about 8,000 as I've been guiding earlier also. This was specifically in October where the Shara and Diwali fall within that month. So I think there were less number of days, and that is why this is one of the reduction. But I think we will continue to maintain about 8,000 net addition. On the margin side also, you are right. We are probably bottomed out at 25-28%. Now we will start to increase the margin from here on slowly.
Mr. Agarwal, but you're saying this even as we are seeing signs of some amount of slowdown, right? Especially on the rural front, even urban, as some of the earnings are showing us. SMEs, etc. Are you seeing any of that slowdown in your business at all, or no?
It's too early to say anything like that. We are well diversified across geographies and across industries. And also we have invested a lot in terms of sales and product and technology in the past 18 months or so. So I think we will try to nullify some of that in the coming quarters or so. But it is too early to say any negative impact on that.
Okay, I think the reason my colleague is asking you about the slowdown is because if you look at the 9 months revenues, right? I mean, it's up about 30-odd%, and the deferred revenue growth at 28% is lower than what you've seen in the last many quarters. So is it fair to assume that growth will slow down compared to preceding quarters? And is there any merit in the argument that perhaps, the environment itself is a bit challenging?
I mean, I cannot comment on 1 or 2% here and there, but
Sure.
On an average, as I've been guiding, that if the collections from customers continue to grow at 25-odd%, the rest of the deferred revenue and revenue from operations will also trend in the same line in times to come.
Okay, there's also the traffic, right? The numbers are showcasing that inquiries are perhaps on the lower side. The traffic is down about 3.5% this quarter. What explains that?
I think, post-COVID, during the COVID lockdowns, there were multiple industries and multiple shortages that were there. And so probably there was a surge in the traffic. But now, if you see for the last year or so, the traffic has been maintained at the same levels. And we are happy with that.
Okay, all right. Mr. Agarwal, the other supporting factor or the bit of a googly for the street is what do you do with the cash? Will it be some more inorganic growth, or are you planning on returning some wealth to the shareholders? This is always a bit of an interesting aspect, supports valuations at times. But what do you do with it? Give us an outlook.
So we have been maintaining that about 1/3 of the cash is being returned on a longer-term basis, and we will continue to do that. For the rest of it, we will continue to find interesting opportunities inorganically if we find anything.
Okay, we'll leave it there. Thank you very much for joining us. Appreciate your time here on CNBC TV18 as always. The market, by the way, is down about 26 points. Let's just take a quick look at the big stocks, right, which were moving. One is Asian Paints, if we can have the intraday up. What is it done after, 30 minutes of trade behind us? 35 minutes. Asian Paints is down 1.5, 1.25. It's off the lows, by the way. Lever is the other one. That also had bounced off the day's low. The open was the low on that one. There was, of course, LTTS, that is L&T Technology Services, which was responding to numbers that had started lower. It's been down for a while. And that is actually the one which is taking a sharp knock, 3.33% lower. Coforge is also reacting to numbers. That, on the other side, was one of the top gainers that we had through and through. So things are looking pretty good as far as the Coforge stock is concerned. $200, 4,175 on the name. It's reacting to a strong set of numbers. The company has seen the highest ever order intake of $345 million. The company has also upped its FY23 revenue guidance to 22% from 20% earlier, and the adjusted EBITDA margin guidance has been maintained at 18.5 to 19%. Sudhir Singh, Executive Director and CEO at the company, is joining us. Mr. Singh, great to have you with us here. Thank you very much for your time. You know, at an environment like this, when it's kind of a bit of gloom and doom, at least people are projecting that a slowdown is coming, a recession is coming in some cases, you're upping your revenue guidance to 22%. Could you tell us what led you to do this? What were the reasons behind it?
Well, it's been a very solid Q3. We've signed, you were right, it's not just the highest ever order intake in the history of the firm. We've signed 5 large deals in a somewhat uncertain macro that everyone's talking about. The highest number of large deals that we've signed, one of them was a $50 million plus deal, 2 of them were $30 million plus TCV deals. We've seen our gross margin go up 133 bits, which continues to allow us to invest in sales and marketing and back-end capability build. And the fact that we have 5 large deals under a belt, the fact that we have the highest ever order intake in a quarter, the fact, even more importantly, that our 12-month order book again is at a record high gives us the confidence that we should be able to withstand most scenarios specific to an uncertain macro that we should be able to meet. That's why we've given a guidance of 22%. We believe that guidance also is conservative, because that guidance of 22% means that we only need to grow 3.5% next quarter. We've already done 3.7 in Q3, which is a shorter quarter. So we do think we'll meet 22%, hopefully exceed 22% as well.
Okay, that is a very optimistic view. I think I haven't heard you so optimistic in a while. We've been speaking for so many years, but I get your point that, you know, amidst all the challenges, this is a supernormal growth, so to speak. You have a $2 billion revenue milestone as well. Can you tell us when could you achieve it realistically, and will you look for any acquisitions to bolster growth and reach this target?
Well, we're going to touch $1 billion in the current quarter. The quarter that just closed is when we hit the $1 billion run rate. This year, which closes in Q4, obviously, is when we hit the annualized, the annual $1 billion run rate. The intent is to get to a $2 billion with great speed. If you look at our record over the last 5 years, last 20 quarters, we have come through most scenarios, including COVID, when the travel industry went down and we had exposure to it, figured out a way to drive very, very strong growth. We've been growing almost 20% over the last 5 odd years, CAGR. We'd like to continue to move with speed, hopefully greater speed as we get to $2 billion. That's how I would characterize.
All right. Sudhir, if you could give us a timeline. By when do you get to $2 billion? And also the record deal wins. You know, that's very, very encouraging. For FY24, what sort of a broad number could we work with based on, you know, the current scenario?
So we haven't called out publicly. Even on our investor calls, we haven't established publicly the timeline by when we want to hit $2 billion. Internally, as you can imagine, we have the quarter and we have the year packed down. That's what we are planning towards. The large deals, the velocity that you see obviously has taken some time in building up. If you look at us as a firm over the last 5 years, last 20 quarters, we've talked about an ability to command a price premium, drive margins up, use those margins to keep investing in sales marketing capability. At a time like this, when macros are uncertain, is when a firm like us believes, when a team like us believes you need to lean in, drive growth, differentiate. The team that we built up, the capabilities that we created, is what's led us to sign 5 deals in the shortest quarter of the year in the midst of uncertain macro. So, I mean, it's been a cumulative effect. Effort, it's taken time to build, and it gradually seems to be yielding the dividends that we always wanted to see.
So when you say drive margins up, how much do you think you can expand margins further? It's been in this 13-14% range, but you are doing a lot, whether it is increase in offshoring, operational efficiencies. How much do you think the margin band could move up to in the near future?
Well, in the near future, we think we have significant leverage to be able to take the margin up. If you look at just the current quarter that closed, our gross margin went up 133 bips. We've used almost all of it, about 120 out of that 133, into continuing to invest in sales, marketing, and capability to ensure that the growth rate does not slacken over the gradient we've built over the past few years. So we think, given how offshore has done for us, our offshore revenue has gone up 16% over the last 9 quarters. That's a huge swing. We have significant margin buffers. It's not a question of how much can we grow. We think we can grow significantly. It's more a question of when do we actually dial down the investments and let most of the GM start flowing down to the EBITDA and to the PAT. Current scenario, we suspect we'll continue investing, we'll continue chasing growth, but margins have the offshoring having gone up, the utilization having gone up, the number of GET, graduate engineer trainee pool having gone up, gives us significant margin cushion at a time like this.
So even if FY24 throws a curveball, you should be you well placed overall on all aspects. Do you expect it to? That is, this calendar year to be significantly tougher than what you've had to face last year?
This calendar year, especially the second half, the macros we're all aware have been deteriorating. I think we've still found a clear way to accelerate growth while the macros have gone and trended in the direction that they have. Currently, where we stand, and as we consider the next year, fiscal year 24, we feel very, very good. We feel very, very good. One, because the locked-in order book is as strong as it is. It's at about $845 million already for the next 12 months. The order intake has been the highest ever at about 345 odd million. We have 5 large deals which will actually start delivering revenue impact from Q1 of next year with a little bit of a lag. So we feel very good about the revenue buffers and the margin parameter buffers that we built up for the business right now.
You know, Sudhir, on a day-to-day business, we get a lot of managements, we get a lot of experts as well. We keep asking them, how are you feeling about the sector, the IT space? Well, you're pretty much, blazing all cylinders as we speak. But besides the operational performance and besides the path ahead, there are a couple of other aspects. One is you had an ADR listing plan that was pushed back a little bit. So what's the update out there? Point number 1. And point number 2, Baring's stake used to be around 70%. That's come down to around 40%. Any clarity on that? Because that's a bit of a supply overhang. Go ahead.
Sure. So the ADR we've been very clear about. We've already listed with the SEC. We have an F1 file. We keep refiling it. We've always maintained that the firm is intent on doing an ADR. And yet, at the same time, we're in no tearing hurry to do it till the market stabilizes. It's a secondary ADR. We'll keep looking at the market. We will keep refreshing the F1 application. Doesn't take too much effort once you've done it first time around. And we will then pull the trigger around that once the market is in a position where it is more receptive to secondary ADRs than it is at the current point in time. The second question that you had around Baring, you're right, has come down from 70 to 40%. They're very valued shareholders as far as we are concerned. They've been extremely productive on the board in terms of the guidance and the support that they've provided. We hope they're going to be there for the longer term. And their plans in terms of how they move forward, of course, is something that they would be best placed to answer questions around.
I do understand that you are quite optimistic about the future, but some of your verticals have seen a bit of pressure, right? Whether it's insurance, which was down about 3%, BFSI, in fact, was flat, so there was no growth there. Travel, tourism, barely about a 2% growth. Can you talk about whether you saw any kind of furloughs in the insurance and BFSI sector? What was the reason for the weakness there? And would you extrapolate that for the rest of the year?
Let me make sure I get this right? We've seen significant furloughs and we've seen significant growth. BFSI is growing year on year 33%. Travel is growing 25%. Quarter 3, as we all know, is a seasonally weak quarter for IT services, and yet our performance has been one of the best across the industry. So I won't look at the Q-on-Q numbers that you're citing. I look at the YOY numbers. BFS continues to grow. As I said, 33%. If I get this right, 33 or 39%. Travel is growing almost 25% on a year-on-year basis. So these verticals are good. And the point that I do want to make is it's not a question of us being optimistic, right? Most of what I'm telling you is driven on the track record built over the last 20 quarters. it's not just the last 8 quarters when the demand went up during COVID that we did well. We were doing well for the 3 years preceding the COVID-induced demand. And a lot of the assertions that we make around driving robust, sustained, profitable growth in the quarters, in the years ahead, comes from that track record and the learnings that we've had there.
Sure, I do understand that, and it comes as a breath of fresh air, especially at a time when peers are talking about ramp downs, clients delaying decisions, etc. I take your point, and all the best for the future. Thanks a lot for joining in and giving us your view. That's Coforge, by the way, the biggest stock in focus this morning. It's up almost 5%. Very optimistic commentary from the management. They've raised their guidance, and they say that even this raised guidance is a bit on the conservative side. So just keep an eye out on the stock. Let's bring you some exclusive commentary from Davos now. We are engaged closely with current shareholders to ensure enough capital is brought in for Vodafone. That's the word coming in from the Telecom Minister, Ashwini Vaishnav. He spoke to Shireen Bhan, so listen in to what they had to say.
Voda needs capital. For capital to come in, capital has to come in either in form of equity capital or debt capital. Conversion is a non-cash transaction. Non-cash transaction is not going to bring capital. So what's important is that this is a very complex issue. I wouldn't like to comment more than this, but certainly we are engaged very closely with the current shareholders and make sure that there is enough capital is brought into the company so that it survives.
Capital from the promoters, you mean?
Yes.
All right, well, that's the word coming in there. Let's slip into a quick break for the market. It is very, very quiet, not a needle moving here and there. So we'll get Mitesh Thakkar to tell us more about how to approach trade for the rest of the day. Stay tuned.
Okay, welcome back. The index is not doing very much. It's a sleepy kind of trading. I mean, look at the screen, not very much. And it's been that way since the morning. Look at Havells. I mean, that is seeing a sharp fall. And the stock opened at about 12.05, went up about 10, 11 rupees after the opening level. And from there is just one way, a complete slide, 60 rupees lower, 11.48 on Havells. So consumers are not having a good day. I mean, consumer stocks, that is, I mean, of all hues and all variety, paints and cable companies and whatnot. Of course, I mean, there is Lever, which is down as well, off the lows, though. Well, Mitesh is with us to tell us what to do now in terms of specific trades and a quick view on the Nifty as well. Mitesh, over to you.
On the Nifty, I think nothing yet. Very, very quiet there. Very, very contracted range. I think 18,185 was the level, which the market made an intraday high on the 18th of January. So I think once we start getting past that, some momentum can come in, but till then, wait out. On the stock side, I have one buy and one sell. Coforge, I think, was a stock just being discussed. A good breakout over there. Looks like it's starting some kind of an up move. It's a buy with a stop at 40.80 for a target of around 4,400. Slightly positional kind of a view. And on the sell side is Nestle. Disclaimer, we have some positions over there. It's breaking down Nestle. So that's a sell with a stop at 19,600 for targets of around 19,000.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's tell you about a couple of stocks. One is Hindustan Zinc, that's down in trade, and Vedanta that opened up higher, but that as well has come off the high point of the day. First up, Hindustan Zinc came out with a set of numbers, but they also declared a dividend of close to around 13 rupees. That takes the total year's dividend to around 49 rupees 50 paise. They're paying it out. Vedanta is receiving it, so good news for Vedanta. The bigger news, though, was that Vedanta will sell its international zinc business to Hindustan Zinc for a valuation of $3 billion, which is massive. 80% of that money has to be paid upfront. Now, just putting in the numbers, and if you analyze what international zinc business did in the first half of the year, well, still the deal is valued at around 10 times EV per EBITDA, which is extremely expensive. The other factor is that Hindustan Zinc has close to 11,000 crores of cash in its books, and they're going to be paying 24,000 crores. So from a net cash, they'll go to a net debt company. And finally, it's a related party transaction, so that's why it's viewed negatively. Good for Vedanta, though. They're going to be getting dividend. They're going to be getting $3 billion. And also, they've included a 2% brand expense that will be paid from Hindustan Zinc to Vedanta. So good news for them. CLSA, they have an underperformed rating on Vedanta. They've maintained their target price around 295 rupees. But a couple of brokerages like Investec as well as Nuvoma, well, they have downgraded the stock, that's Hindustan Zinc, and explains why that stock is under some pressure.
Okay, well, let's move on. The mid-cap IT space is in focus. Emphasis on our radar. Rima is here to tell us why. Rima, over to you.
Thanks so much for that. So Emphasis reported a constant currency revenue growth, which is down 2.5%. And that's the reason why the street is disappointed. This is the only mid-cap IT company which has reported a decline in its revenues. The reason is its exposure to the mortgage business, which gets impacted in a rising interest rate environment. This is one of the reasons why Emphasis revenues for the last couple of quarters have been a bit subdued and the stock has been an underperformer. The worry is that interest rates are still very high and it's likely to be higher for longer, which basically means the mortgage business for Emphasis is likely to remain under pressure. That said, the deal wins were very, very solid. The deal wins have come in excess of $400 million, the second highest on record. The company's margins are flat on a quarter-on-quarter basis, and for the full year, they've maintained the margin guidance at 15.25 to 17%. The internals of the numbers also not looking good. BFSI revenues down 3.5%, TMT logistics under pressure. United States has seen a decline of 2.9%, and headcount has fallen by nearly 1,400 employees, and that is read by the street as a signal that perhaps things are going to slow down, which is why they are reversing on their hiring plans. Perhaps we'll get more clarity from the management on that. But right now, it's the big top-down miss, the decline in revenues, which has spooked the street. Back to you.
Okay, got that. Thanks a lot, Reema. Well, let's move on. Sun Pharma is also in focus. Ekta is here to tell us why she's tracking that one. Ekta.
Thanks for that. Well, Sun Pharma is in focus because they've acquired a listed biotechnology company in the US called Concert Pharma for $567 million. There are additional payments to the tune of around $250 million, which is linked to some milestones. Now, sales of Concert Pharma for the 9 months CY22, $29,000, net loss of $90.6 million, and an R&D expense on an annualized basis of around $100 million. Now, one of their lead product candidates is basically a molecule which is being studied for alopecia, and they're looking to submit a new drug application to the US FDA in the first half of 2023. Now, in terms of the impact of this acquisition, it is probably going to help, Sun Pharma scale up in terms of the branded as well as the specialty portfolio. But at the end of the day, one needs to see whether this drug is going to come to market, whether it has a safety profile which will match the requirements of the US FDA. Also, for Sun, earnings could be impacted due to marketing expense launches. It is estimated in FY25, so that is probably going to weigh in terms of margins. And separately, the annual losses of Concert, which could eventually result in an EPS dilution for Sun Pharma if it is taken on board entirely, and hence that is probably weighing on the stock at this point.
All right, Ekta, thank you very much for that. Well, that's Sun for you. The market's flipped into the green, but only by about 5 points or so. 18,112. It's very, very quiet, but not quiet if you look at stocks, which we've been highlighting. We'll take a break. On the other side, my colleague Lata connects with Sumant Katpalia, Managing Director and CEO at Indices Bank, to discuss their third quarter numbers and outlook going forward.
Indices' Q3 numbers has added many feathers to the bank's cap. The bank's loan growth is at nearly 20%, margins at 4.27%. These are impressive. They've helped a sharp rise in the return on assets to 1.87%. Now, that's really impressive. And a return on equity to over 15%. To give us an idea of how much of this is because the times are good for all banks and how much of it can be sustained, I have with us the Managing Director and CEO, Sumant Katpalia. Sumant, thank you very much indeed, and many congratulations for a great set of numbers. The stock market has given you a thumbs up, a lot of buy recommendations and target price increases. But let me come to brass tacks. A great ROA, but do you see it going to 2 and beyond 2? What guidance can you give us on the ROA front?
So we've always said, first of all, Lata, good morning and Happy New Year to you. We've always said that our ROAs will be in the range of 1.8 to 2.2%. And I think we are in that range. You should see that moving up gradually. And I think next year onwards, you should see us at 2% ROA.
Okay. Well, what is now heartening is that your corporate loan growth is a tad higher than your retail loan growth. It's about time the Indian banking sector also veered around to that. But within the corporate sector, you're not giving too much to mid-corporates. Can you give us some granularity on whether we should smell any risks and whether you're happy with the quality of assets that you're lending to?
Yes, I think on the large corporates, we do lend to A-rated paper and above. But yes, it's a 3.5% growth quarter on quarter. I think we have taken up, we launched a new segment in the 100 to 500 crore. I think we are seeing a good growth there. I think on the supply chain finance, we're seeing a good growth. And I think the small and the mid corporates are growing at 11% for us. And I think that's where our growth is coming. This has been 3 years now. We've not seen any big flows out from there. And I think we are very, very cautious in the way we proceed on that. So we're coming from a small base, so the growth percentages look higher. But I think the growth is very, very granular, and the average ticket size in the mid corporate is about 30 crores.
Okay. Well, now let me come to something which perhaps is bothering many banks, and it's very evident in yours as well. The net interest margin. 4.27 is impressive, but is this the peak?
We've always said we will be in the range of 4.15 to 4.25. And we've always maintained our book is such that it rebalances itself. So there's a fixed rate book of 50% and there's a floating rate book of 50%. So I think if you look at that, I think we are naturally hedged as a book. And I think we will continue to see these margins even if the interest rates go down, because I think the fixed rate book will take over at that point of time. And slowly if you look at the retail yields have only increased by 16 basis points against corporate yield of 37. And I think over a period of time, as the disbursements are at the higher rate, you will see the fixed rate book yields, which will come to around 30 to 35 basis points higher over a period of time. So I think it's a lag effect which is coming in the retail book, and I think we will continue to maintain these margins at 4.15.
It is not your assets that I'm worrying about at all. I'm worried about the liabilities. I mean, your current and savings account deposits are as a percentage of the total falling. It's fallen for all banks. It's fallen for you as well. And you can clearly see that you have to pay more to get your deposits. So that's why I'm asking, how much does it go? Would you be able to even maintain 4.15?
See, we have been able to maintain it. This was the talk which happened last quarter that they will not maintain, and the brokerages did say that we will come down. I think we did not come down. So as long as your corporate book gets repriced and is getting repriced, you're able to pass on the margin, and the retail book is happening at, the disbursements are happening at a higher yield. You're getting a repricing on that coming after a lag. You're able to reprice the business. Yes, it's 4.27. It may come to 4.24 or 4.30, but it's range bound between that number.
Okay. How much of your book is of your assets are linked to external benchmarks?
So we have a book, 50% of our book, 20% of the book is linked to MCLR, another 20% is booked to external benchmark, and the other is linked to short-term rates, which is a short-term book.
Okay, okay. So would you say that going forward, I mean, almost everyone's expectation is either the Reserve Bank's rate hikes are over or at best one more. So people with fewer linkages to external benchmarks are at an advantage because, you have more headroom to raise rates.
I think I told you that our book is very well balanced, and I think as the interest rate slows down and the hikes slow down, I think our fixed rate book will start giving us the real value, because we booked in the last 4 quarters disbursements at very high yield, and our disbursements in retail side have been very, very high.
Okay, well, now let me come to one part of your slippages which is pretty troubling, and that is the microfinance leg. There, while your absolute value of GNPA is 525 crore, the microfinance GNPA is like 268 crore as the increase. Now, that is a little worrying. You have also disbursed a lot, 8,928 crores, but the book has not grown. Why that?
So first of all, the runoff effect comes into place. It's a base effect. So we were disbursing at a higher speed, and I think the runoff effect, because these are 12-month to 18-month loan, and the runoff effect. So we have a 3,000 crore runoff. So that should answer your question that the book is almost static as a consequence of that. Second, I think on the flow side, I've always said that the rural economy is still work in progress, and we will see some turbulence in some part of the countries, and I think this is mostly coming from the eastern side of the country. I think it's going to stabilize in a quarter or so, and I think you will see a very stable book from Q1 onwards on this book, on this microfinance.
Okay, can you give us some more nuanced guidance on the slippages part itself? I mean, there have been slippages even from your restructured assets, a little bit of worries even on the CV portfolio. Just tell us what should be the asset quality that we should worry about.
So if you look at our slippages are down to 44 basis points, 40 basis points this quarter. And I think you would see the slippages going down as we move forward. The commercial vehicle, the vehicle side of the book will stabilize now going forward. And in Q4, you will see the stability of that book. I think the slippages came from one particular state, and that was because of the mining tax, which has been rolled back by the government. And I think a lot of companies which do commercial vehicles and construction equipment will see that type of slippages which will come in. And I think that's all rolled back, and you should see the impact coming back onto the book this quarter. I think on the microfinance, like I said, I think it will take a quarter or more before it stabilizes. And we have been very upfront in taking our losses. And I think we even take losses at 60 DPD if we feel that there is no chance of recovery. And I believe that you should be prudent in microfinance in taking losses. And I think this will be the last quarter. And going forward, we should stabilize at what we've said. Having said that, our guidance has always been between 130 to 150 basis points of credit cost this quarter. This year, I think we should come within that range, plus minus 5 basis points. And next year onwards, we should be at 110 to 130 basis points.
Okay, that's really good to hear. But you spoke about 60-day past dues and how you're worried about them. Now the banking system has to worry about them because sooner or later you have to provide for expected credit loss. What is your SMA 2? In fact, your SMA 1 and 2?
So our overall SMA 1 and 2 is 28 basis points down, 32 basis points down from 52 basis points. So I think we don't have that problem, but you have to look at this ECL in the retail side also, which are not part of the SMA 1 and 2. And I think there are some advantages, some disadvantages. The secured lending book, I think you will see a very good take up. I think on certain parts of the book, you may see a certain hits coming in. So I think we are talking to RBI. RBI has asked for certain questions. We are going back to them. So I think overall, I think it should be neutral, but I think we have to see how each bank has created its behavioral model. And there will be some inputs from RBI on some of the parameters which have to be taken. And then we can decide what is the way forward on that.
Yes, I agree that these are early days. It's only a discussion paper. We will get a draft and then you will get the final rules. And then you will get, in that rule, you will get how much Reserve Bank wants you to provide. But do you have a healthy capital adequacy. Do you think because of this ECL, you may have to raise capital just to be sure? After all, the market is very kind to banks at this point in time. It's very much in favor of banks at this point in time. Would you want to raise capital just to be prepared for this expected credit loss thingy?
So we've done all our simulations. The past simulations don't seem to suggest that we need to raise capital. Even our growth does not seem to suggest we need to raise capital because our internal accruals are such that it's taking care of our growth. We still are at 16% CET1 and 18% overall capital adequacy ratio. So I don't think we need to raise capital, but I think we will take a call maybe by the second, third quarter of this financial year, depending on more clarity coming out from this discussion paper. At that point, we will take. But in my view, I think our growth as well as the expected credit loss model will not make us raise capital as of now.
Okay, will not require you to raise capital. Okay, got that, Sumant.
No,
out of time.
Absolutely.
Out of time, but just wanted to know anything the Reserve Bank told you at all about confirming the reappointment? Your reappointment?
No, not at all. We still await their confirmation.
All right. All the very best, Sumant, for the reappointment and for the next innings at IndusInd Bank. Thank you very much indeed for joining us. Great set of numbers. Okay, we have to wrap up on Bazaar itself. And the positive part is now the market is quite definitely moved into the green, in particular the Nifty Bank. On that point, I hand it over to the Chartbusters team after a very short break.
Co-powered by